Did you know that over $7 trillion is traded in the forex market every single day? That is even more than the stock markets and the crypto markets all combined. But what exactly is forex trading and how does it really work? In this video, I'm going to break it down in the simplest way possible, that even if you're a beginner, you will understand what forex trading is all about. Without wasting too much of your time, let's dive into the video. Welcome to QAFX Academy, where we simplify forex and trading strategies so you can trade smarter. If you're new here, please click that subscribe button so you don't miss any of our weekly trading tips. So, what is Forex? Forex stands for Foreign Exchange. The FOR stands for Foreign, while the ES stands for Exchange. I hope you get that now. So, what is now Forex trading? Forex trading is the art of buying and selling of currencies on the global marketplace with the aim of making profits. It's basically about exchanging one country's currency for another. For example, trading euros against US dollar. Although everything happens online through brokers and banks across the world, and the market runs 24 hours a day and 5 times in a week. Very specific, Monday to Friday. So the market is opened from Monday to Friday. So when you trade forex, you are buying one currency and selling another at the same time. Although the goal is to buy when the value is low and sell when it goes higher, so you make profits from the difference. In simple terms, forex trading is just about predicting how one currency will move compared to another and using that movement to make some money. So, how does it work? In forex trading, currencies are traded in pairs. For example, Euro USD, pounds versus Japanese yen, US dollar versus Japanese yen, pounds versus US dollar versus Canadian dollars, US dollar versus Nigerian naira, and so on. So, in forex trading, currencies are always traded in pairs because when you buy one currency, you are automatically selling another. For example, pairs like USD, pounds, Japanese versus Japanese yen, US dollar versus Canadian dollars. All of these pairs, they are only showing you the value of one currency compared to another. Let us make it even more simple using US dollar versus Nigerian naira. Let's imagine that you go to the bank to exchange your money. You give them naira and get dollar in return. That means you are selling your naira to the bank and you're buying US dollar from them. Once you give them your naira and they're giving you the US dollar, you are already doing what they call buying and selling. You are trading. You understand? So you are selling your Nigerian naira to receive US dollar. So now let's say the exchange rate is around 1,600 for $1. That means one US dollar, it is equals to like 1,600 naira. Now, if the naira later becomes weaker and the rate rises to like, let's say 1,700 or 1,800 naira for $1, and you decide that you want to exchange your dollar back to naira, you will get more naira than you originally spent. You know, when you bought the dollar, you bought it for around 1.6, and now when you want to sell the dollar to buy back naira, you are selling $1 to receive 1.7 or 1.8. So that extra money is your profit. So that is basically how forex trading works. But instead of going to a physical bank, everything happens online through trading platforms like SNES, OptiFS, Bybit, and so on. So let's quickly talk about the currency pair. So under the currency pair, we have the base currency and the gold currency. So what is base currency? The base currency is the first currency and it represents the main currency you are buying or selling. So let's take a look at this example right here. Euro versus US dollar. Now, the euro is the first currency, while the US dollar is the second currency. The first currency here is euro, and it is our base currency, while US dollar is the gold currency because it is the second currency. So now let's quickly take a look at the meaning of gold currency. The gold currency is the second currency, and it tells you how much of that currency needed to buy 1 unit of the base currency. Now, just like the example I gave earlier about the US dollar and Nigerian naira, when you go to the bank, you give them a particular amount of naira to buy $1. In that case, US dollar is the base currency, while the Nigerian naira is the gold currency. The bank will give you a particular rate for you to get $1, right? And the rate was 1,600. So that is what the definition is talking about here. It says it tells you how much of that currency needed to buy 1 unit of the base currency. So now, whenever you hear about currency pair, you should understand that two currencies are involved. Our first currency here is the euro, which is the base currency, and the second currency here is US dollar, which is the gold currency. Before I move on, I want to explain this base currency and the gold currency with the candlestick. So you must have been seeing green candle, red candle. Anytime you see red candle on the chart, you'll be like, this thing is going down. Anytime you see a green candle on the chart, you'll be like, this thing is going up. So to most people, or to beginners, they feel like red candle is a good candle, while red candle is a bad candle. But in trading, it is not like that. Green candle it indicates when the market is moving or going up or moving to the upside, while this red candle indicates the market is going to the downside. The base candle represents the green candle, while the gold currency represents the red candle. So, but the thing is, you can actually change the color of the candle. You can actually change it. So you can decide to use color blue for the base currency, while you can use whatever color, maybe like black or white, for the gold currency. Whenever you see a green candle forming on the chart, it means the euro is getting stronger while the US dollar is getting weaker. But whenever you see a red candle forming on the chart, it means the US dollar is getting stronger while the euros is getting weaker. This is the currency pair we have here, the euro USD, that is euro US dollar. So as you can see now, the market is forming a green candle. This means the euro is getting stronger against the US dollar. This red candle, it means the US dollar is getting stronger against the euros. That is why I said this green candle, red candle, they represent the base currency and the gold currency. But in this scenario, the green candle represents the euros, while the red candle represents the US dollar. Okay guys, we've gotten to the final part of the video, and I'm very sure you must have been wondering that Even after all of this, how do you still make money in Forex? Alright, there are some principles in Forex trading, and the principles are: you buy low and you sell high. It is either you buy low and sell high, or you sell high and buy low. We are still saying the same thing, but let me show you an example. Let's say you bought an asset for around $1.19 and you sold the asset for $1.21. The difference between 1.19 and 1.21 is your profit. And now let us use the sell as an example. Let's say you sold an asset for around $1.19 and you bought back the assets for around, let's say, $1.17. So the difference between $1.19 and $1.17 is your profit. Okay, let me even make it more simple for you guys. Let us use another scenario. For example, now you sell shoes. Let's say you bought the shoes for around $100 and you sold them for around $300. You bought for 100 and you sold for 300. You made a profit of $200, right? And now let us say you sold the shoes for $300, and when you went back to the market to restock your business or your shop, and you got the shoe for around $50, you see that you made profits. Even though when you bought this shoe around $100 and you sold for $300, you made profits when you bought and you will sell. And now you sold for around $300, and when you went back to the market, you bought for around $50. So 50 to 300, you made a profit of $250, right? So let's relate that to Forex trading. When you buy an asset at a cheaper price, you are expected to resell at a higher price. And when you sell at a higher price, you are expected to buy at a lower price. That is how you make money in Forex. So you're going to make money when you buy and the market moves your way. Maybe probably the market moves to your upside, you make money. And when you sell and the market dump aggressively, you make money. So for those of you who thinks you only make money when you're seeing the green candle only, you are wrong. No, you can also make money when the market is dumping aggressively to the downside. So it only depends on your speculations. If you speculate that the market should go up and the market is moving to the upside, you will make money. And if you speculate that the market should dump aggressively and the market is going to the upside, to the downside, you are going to make money as well. So you just have to get your prediction right. But if you speculate that the market should go up and the market is dumping aggressively, you are going to lose money. You just have to cut your loss, you understand, by setting your stop loss. And if you speculate that the market should dump aggressively and the market is buying or pushing to the upside, you are going to lose money. So for you to make money in Forex, you must get your speculations or your prediction right. And for you to do that, that is why we have what we call fundamental analysis and technical analysis. So if you found this video very helpful, don't forget to like, share, and comment your thoughts in the comment section below. And also, please don't forget to subscribe so you don't miss out my weekly trading tips. In the next video, we are going to discuss about PEEP and lot size. You don't want to miss this. See you in the next video. Bye.